Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Thank you for coming on what I know is one of those days where you probably debated pretty heavily. Do I stay and do my assignment? Do I turn up to class? I appreciate it. I wish I could reward you by giving you a hint for the assignment, but, you know, that's against the rules. And really, there is no hint that I haven't already given you in the workshops. But just let me remind you, please remember it is a 3 o'clock due date. It is time tomorrow. It is not 5, it's 3. After 3 o'clock, Turnitin, as far as I understand it, will not allow any more submissions. You can't email them to me. There is no potential to be late. You must be on time or you'll get 0. So I would be aiming to hand it in at least an hour before. What if the internet goes down? You know, there are all these issues that the earlier you submit it, the safer you will be. And remember, it is only one person that can submit it per group. Please don't have multiple people submitting the same assignment. The risk is that one of my markers in marking the over 100 assignments that you guys hand in would waste time marking the same assignment twice, which obviously is what we're trying to avoid. All right, so what we're going to do today is we're going to further narrow our focus when we look at the portfolio construction process. So remember, we spent the first 5 weeks looking at how to allocate money between different asset classes within a fund. We looked at mean variance analysis. We looked at a number of alternative approaches like fill the buckets, like the fundamental risk approach. And we looked at some of the issues with the assumptions that we make and the data that we use. Then what we did from week 6 through to last week is once we learned the techniques to allocate money between asset classes, we then moved on to understanding more about each individual asset class themselves, right? So we looked at equities, then we looked at fixed income, then we covered our alternatives, and last week we finished that look at the different asset classes with a look at where you want to take a global exposure and where you might want to just be local. And if you do want to take a global exposure, particularly in equities, how much do you hedge and how much do you choose not to hedge against currency risk? That takes us to the last 2 weeks. Now, what we're going to do today is we're going to say, all right, well, now that we know how to allocate money between asset classes, and now that we understand more about the exposures and drivers of each individual asset class, how do we go about taking any given asset class and turning the amount of money we've allocated into that class into an actual portfolio of investments? Now, to do this, we're going to focus on equity. It's what you guys are most familiar with, which makes it the easiest to sort of understand. You're not trying to understand about the asset class and the implementation. You guys know equities back to front, so you can focus more on the methods that we talk about. But what we talk about today could be applied to the other asset classes as well. We're just using equity as an illustration. Now, there's a lot you could talk about for this type of thing, which means that the benefit of this week is it's an interesting lecture in terms of starting to understand how you end up with a portfolio of investments, but it's not a heavily technical lecture, and it's not in any way a mathematical lecture, right, which is probably a relief after the currency hedging of last week. Right, what we're doing is the goal is for me to give you guys an idea if you're allocated money into an equity bucket and you're, for example, either deciding how to split up that equity bucket between different managers, or you are one of those managers, how would you go about, how would you take the journey from the point of receiving the money to actually realising that into a portfolio of investments that you manage through time? Okay, so we're going to look at what we call the investment process. We're going to start with an investment philosophy. We're going to turn that into an actual portfolio. We're then going to look at what we call multi-manager investing, right, which is a very similar argument to diversification among stocks. If you're a superannuation portfolio, you have a bucket of money that you're going to allocate to Australian equities, but you're not going to invest the equities yourself, right? Because remember, some funds have an internal investment team, others outsource. If you choose to outsource, you're going to take that money and give it to external portfolio managers who will invest in the end assets. So the question is, do you give everything to a single manager, or do you split your wealth between different managers? Multi-manager investing is not giving all of your money to a single manager, but distributing it among the different managers. And the idea is that particularly if those managers are active, they may give you alpha, but they'll also give you tracking error risk, right? Because by definition, to be active, you're deviating away from your benchmark. So by spreading your wealth between different active managers, providing all of those managers are good, they give you positive alpha, what you can do is you can keep your alpha equal to the average alpha between them, but reduce your tracking error below the average of each individual manager's tracking error risk, right? Which is exactly what we learnt with stocks, right? You invest in a number of different stocks, you keep return equal to the average return, you reduce risk below the average risk. We're just doing it at a manager level here. And we're going to finish up by looking at the influences that will determine whether you might want to go active or passive in an investment. We're going to start by sort of the area that's really heavily debated. You know, do active managers add value? Are they worth the money? Is it a zero-sum game? And then we're going to finish with a look at more just the realistic constraints of a portfolio, right? I mean, let's say that you genuinely believe that most of the time passive is better. But if you're trying to invest in an asset class that doesn't have a passive alternative, then you have to go active. Right? If you want to invest only in stocks that have strong ESG ratings, well, if the passive index has a lot of low ESG companies in it, that might actually be against your mandate. So we're going to look at why you might choose to go active or passive, as well as circumstances where you might not have that choice. And then, by the way, what we're going to do next week is essentially next week is what we call the Other Topics Week, and it's just going to bring in all those other little factors that I think might be helpful to understand when it comes to actually forming a portfolio. So by the time we get to the end of next week, you have the tools, you understand the asset classes, you know a bit about how to implement the investment, and you've considered the other things like transaction costs and taxes. So that will round out the picture of a multi-asset class portfolio. Okay, so let's start with the investment process. Let me talk first about why this matters. Let's say that you're trying to decide between two different fund managers. They each have very strong returns over the past year. They're in a similar, you think they might be in a similar strategy, and that they might both have, say, small caps in their name. Or let's say they might have value in their name. They both have strong returns, and you decide to go, okay, well, which manager do I want to put my money with? And you're in a position, you might be running a super fund, so you've got enough money behind you to go and talk to that manager, to both managers, as you make your choice. So you turn up to the first manager and you say, look, I'm looking for a value manager. I like your returns. Tell me a little bit more about how you go about turning the money that you're given into the portfolio that produces those returns, right? And the manager says, oh, well, look, I think I have an innate feel for investing. I go onto my computer and I look at my portfolio, and every so often I'll look at a stock and I just get this gut instinct, sell it, just sell it. So I sell it. And then, I open the paper or I get on Google Finance and I look at the codes, and sometimes I just know I have to buy that stock, so I buy it. And look at my returns, haven't I done well? You're going to go, okay, sure, your returns have been good so far, but probably you're not going to have a lot of confidence that that return is going to continue going forward, right? Because he hasn't given you any information to go on. So you go, all right, that's not looking so good. You go to the next manager and he says, well, look, here's the thing. I have a long-term focus and I fundamentally believe that over about a 3 to 5 year period, stocks can diverge from their fundamental values. It might be because the market isn't good at recognising the inherent value of a rollout strategy. It might be because I don't think the market is particularly transparent in this particular industry or market capitalisation segment. So what I do is I pick certain metrics, and I'm going to tell you, he tells you what they are, or she tells you what they are. I look at these metrics to initially filter my stocks, and then I run a discounted cash flow analysis. When I do my discounted cash flow analysis, these are the key items I focus on. I'm particularly interested in things like long-term sustainable cash flows. As I do my discounted cash flow analysis, I like to analyse company reports. I meet with the managers. I start to understand what is their product, who is their customers, what do they plan to do going forward. I look at the management team and the success that they've had in prior companies. I look at whether there's any interesting things in the news that may affect that company. I take all of this information and I incorporate it into my analysis in ways that I can easily outline. And from that, I come up with a valuation. So I value stocks in a number of different industries. I find stocks that are trading at a current discount with a margin of safety of at least 20%. And providing I ensure that I have a decent spread across the different industries, I will then select, say, either the cheapest stock in that industry or the 10 cheapest stocks subject to an industry spread. Then I monitor those, and if the margin of safety drops to a certain level, I will sell the stocks. Right? This is a very... And I know I often said the metrics X, Y, and Z, but the manager will tell you what these are. This is a very clear process. If it's a clear process, it can be repeated. And if it can be repeated, then you start to have faith that performance can be repeated as well. Okay, so that's the key about an investment process. If you're going to go and analyse a fund, it's not enough to see that they've done well in the past, right? Because they could just have been lucky. I mean, if you happen to invest in Afterpay, did you genuinely believe that this was a technology that was going to absolutely take off because you thought, well, look, people like the lay-by system, they like to spend money they don't have, I think that their technology is good, their strategy is good, and their management team is good? Or did you go, I want to invest in a tech stock today, so I'm going to do that, right? Because if you've got a process that will actually get to the root of why a stock is undervalued, that's what can be repeated. The luck can't be repeated by definition. So what you want to see with a manager is that they start with an investment philosophy that fundamentally tells them why they believe stocks might be undervalued if they're an active manager, or why they believe you can't beat the market and therefore you should be diversified if they're a passive manager. So that's their investment philosophy, and then they have a clear way of converting it into a portfolio. And that way that they convert it is their investment process. So I've already basically explained why it's important, at least the middle thing in particular about why it's important, but just to go through each of the steps on the slide. If you're running a fund, obviously, particularly, unless you're a hedge fund, right, your fees are going to be a function of your assets under management. So you're running a fund, you want to attract fund inflows. One of the good ways to do that is when you end up having a high recommendation by, for example, an asset consultant or an investment researcher. So if someone like Morningstar, an investment researcher, or Mercer, an asset consultant, comes to evaluate your fund, you want them to be impressed for marketing reasons, right? A high star rating by Morningstar is going to bring in, the public will monitor that, and evidence has shown that if you have a high Morningstar rating, you have higher inflows. And if you impress someone like Mercer, they will recommend their clients to come into your fund. Okay, so for marketing reasons, you tend to have a very clear process, because when these guys come to evaluate you, they're not just going to look at the returns for the reasons I explained. They're going to want to understand how you go about turning that philosophy into a portfolio. So for marketing reasons and to attract fund inflows, you're going to have a carefully stated investment process, because that offers hope that the process is repeatable. And the other thing is that having a clear process will help to generate a common purpose within the team. If you're a really small fund, if you're investing on your own, or you're a single manager without any investment researchers underneath you, without any analysts underneath you, then having an investment process is important for marketing, and it's important to give yourself a check that you're always analysing stocks along consistent lines, but at least it's all going on within your own head. If you're running a fund, if you're the fund manager, and it's a massive fund with a lot of assets under management and a potential investment universe of 500 stocks, you're not going to be analysing every single stock yourself, right? You're going to have a team of analysts working underneath you. Now, if you say to those analysts, I want you to find value stocks, and that's it, right? The analysts are all going to go about finding those value stocks in different ways. They're going to use different metrics. They're going to come up with different valuations that are not using the same line items. There's a lot of subjectivity in the process. So when those different analysts come and tell you that their stocks, here are the stocks that I think are undervalued, but you can only pick some of them, it's very difficult to figure out which ones to pick because they've been analysed along different lines. So by having a clear investment process, every analyst knows these are my key metrics, this is my key time horizon. This is the items to consider for my discounted cash flow analysis. This is the margin of safety that I'm looking for, right? That way there's consistency across the methods of valuation, even though different people are evaluating different stocks. So when they then feed their recommendations through to the fund manager, the fund manager has an easier job of deciding the final stocks that will appear in the portfolio. Does that make sense? So it's about consistency, it's about faith that performance will be repeatable because the process can be repeatable, and it's about giving your end investors confidence that you know what you're doing and you'll continue to do it in the same way. Okay, so it's important to have an investment process. It's also important to follow that process. So the next danger that you have is that you've gone to the trouble of writing an investment process 10 years ago, and it's sitting there, I don't know, underneath a coffee mug gathering dust because no one ever looks at it, right? You want a process that is clearly thought out, easy to follow, and is followed. And that comes down to this issue of rules versus discretion. There's always going to be room to be flexible in an investment process. Not every stock is the same. Not every industry is the same. But it does need to be clear, respected and followed, because if you use too much discretion, the danger is that you're not going to have the investment process guide your choice. You're going to make your choice and sort of manipulate the investment process to justify it after the fact. Right? So here's an example. Let's say that the investment process has you evaluate stocks using price-earnings ratios, but you have complete flexibility as to how to actually look at it. Do you look at backward-looking earnings or forward-looking earnings? Do you look at sustainable earnings? Do you take a rolling average? If you have a stock and you think you want to buy it, not because of the investment process, but because you like the stock, but you need to justify that stock to your manager, too much discretion means you're probably going to calculate every one of those metrics and pick the one that sells the story you want to sell. And that's not the way an investment process should exist, right? The decision should come from the process. It shouldn't happen in reverse. So you want a fund to have a clear philosophy that is translated through an easy-to-follow, repeatable process, which the team respects and does follow. Then you're starting to get more and more confidence that the performance that's been strong in the past will continue into the future. But there's one other massive influence that if you don't have strength in the people, the process won't save you. Now, Jeff Warren, who created this course originally, has a paper where he and a co-author went out and interviewed the big superannuation fund managers in Australia. And I actually show you some more of the results later on today. But one of the things that they were asking them is, how do you go about choosing your multi-manager portfolio? Right, so you have money in a world equities bucket. How do you decide which managers get the money? And ultimately what they say is, look, I mean, the style is important. The process is important. But at the end of the day, you have to trust the fund manager themselves. Because if you don't have faith in the actual manager and their team, then you're not going to have faith that performance will continue, because you're not going to have faith that they'll follow the process, even if they're called rules. Right? If you think the manager is unskilled, even if they're using the right techniques, they probably don't have an inherent capacity to recognise a strength or weakness in the business. So this is actually a quote from those interviews. How do you go about picking a good manager? It's the people. The people, the people, the people. The process matters, you want it to be followed, but at the end of the day, a good process is not going to keep investors with them if there is a really good fund manager and that fund manager leaves. So what you tend to see is you tend to have what we call star managers, and you've probably heard of them. Richard Buxton is one of them. Bill Gross is another. Peter Lynch. With these people, the name is enough. When they leave a fund, they tend to take their investors with them when they walk out the door. Okay, so what this is essentially lots of different ingredients where you want to get as many of these into a bucket as possible to start to have faith that the performance will continue. Because it's really hard to differentiate skill from luck. There are some bootstrap simulation techniques nowadays, for example, but they don't tend to be used on a particular fund, and they're not very good at identifying which funds have skill and which are lucky. They're good at identifying how much of the universe is genuinely skilled versus lucky, but not picking those individual managers. So to get the skilled managers, when you can't always rely on their returns because it could be luck, you need to dig into the fund itself, understand what its process is, and trust the people that are executing that process. So hopefully what this tells you is that investment processes matter. And if you ever come to starting up a fund or working for a fund, one of the first things that needs to happen is that you need to know your investment process. There's no point going ahead and executing an investment if you don't know what should be driving it. Now, there are a lot of different ways to describe an investment process, but this is one that I really like, and it's from your readings in the course textbook, which, remember, the examinable readings are up on Wattle. The reason I like the breakdown of this process is it breaks it into stages where you can identify weak points if ultimately the process itself isn't leading to strong returns, right? Because at the end of the day, if you look back over the assessment period and your fund hasn't done well, it's one thing to know it hasn't done well, but it's far more important to know why it hasn't done well. And you might say, well, all right, my strategies weren't successful, but why? Right? The closer you get to identifying where the weakness lies, the easier it will be to fix. So what this process does is, what this breakdown does is take the process and split it up into the different steps. The first thing is, it's really important to have an investment philosophy. So how am I going to go about generating my returns? If you're a passive fund, the investment philosophy is that you don't believe there is a decent potential to outperform in the market, but you do believe in diversification, and therefore you will pursue a passive strategy where you spread your wealth over a broad index. If you're an active fund, the philosophies will vary greatly and are very important because it gets to the heart of why you think that you can outperform. Right? It's not enough to say you have a gut feel, that you look at a stock and feel like you should buy it. Right? You need to have a reason why you think that prices will diverge from their fundamental values. So, for example, do I believe that there is more inefficiency in small capitalisation stocks? Is my strategy about identifying value stocks or growth stocks? Am I looking at creating quantitative models using a number of different inputs, together which will give me a ranking of stocks, and I will buy the ones that are cheap and sell the ones that are expensive? Are there market conditions where my strategy will work and market conditions where it won't work? Do I believe that numbers aren't enough and therefore I need to gain a fundamental view of the company by not just poring over their annual reports but talking to the management team? Whatever it is, it will give you that underlying justification for why you think you'll generate that alpha. Once you have your investment philosophy, you need to actually know what signals will tell you whether or not to trade. So the next step is signal creation. What is it that's going to tell me I should buy a stock or I should sell a stock? Now, ideally, the signal will be clear, but more importantly, it will be clear to you and less clear to anyone else, right? Because if the signal's really obvious for everyone, everyone's going to buy the stock because everyone will be able to see it's undervalued and you might not have the time to profit, right? You want to buy it while it's undervalued and then everyone else purchase it so that demand drives up its price. Okay, so you need to find a signal that's clear to you, less clear to other people, and that will tell you when and whether to trade and whether it's a buy or a sell. Once you know what you want to trade with the signal, you then start to structure what your portfolio would look like if you follow that signal. That's the third stage, signal capture. Right? If you think back to the GFC, once the global financial crisis hit, so many people came up and said, oh, well, it's so obvious. Look at all the warning signs. You can just tell things were going to go wrong. And almost none of them did a single thing in their portfolio to protect against it. It's no good to see a signal if you don't act on it. So what you do in the third stage is you say, all right, well, what, given my signal, do I want my portfolio to look at? Now, here the text talks about a target versus a paper portfolio. And step 3 is all about creating a paper portfolio. In an ideal world with no constraints, if I follow my signals, these are the stocks I will hold. The fourth step is actually taking that paper portfolio and making it an actual portfolio, so implementing those trades. Now, unfortunately, the nature of markets is that we're not in a perfect world. We're not in perfect capital markets. We have transaction costs, we have taxes, we have constraints. So typically, your actual portfolio will not look exactly like your paper portfolio. Maybe you have a maximum on illiquid assets. You've already reached that maximum. So you have a signal that tells you to purchase more illiquid assets, but you can't because you don't have room in your constraints. Or maybe you can purchase an illiquid asset because you're not yet maxing out your constraint, but because it's a liquid, even though it's underpriced, if you're a big enough fund, the amount you'd want to purchase would push its price up instantly and get rid of most of your profit. Right? So all of these things mean that you may not end up with exactly what you want in a perfect world. You've just got to do the best you can, given the market situation you face. At the end of stage 4, you will have an actual portfolio of investments. You then review periodically its performance through time. And you're not just saying, did I outperform or not? You're saying, if I didn't outperform, what went wrong? If I did outperform, is there any way that I could have done even better? So you're reviewing all of the different stages to see whether there's any areas that have room for improvement. For example, let's say that my signal works really well. And had I been able to invest in my paper portfolio, my alpha would have been huge. My actual alpha was positive, but not as big as it could have been. And the reason is that there is some kind of constraint in the market that is meaning that my paper portfolio can't be turned into a reality. Maybe I didn't recognise that though, and so I ended up investing in stocks that were more illiquid than I really should have been given the size of my fund. So the reason I didn't do that well is that I actually moved the market price myself and got rid of my profit. Or maybe the issue wasn't with the way you implemented it, it was the fact that your signal used to work, but it doesn't anymore, so you need a new signal. You find the weak points, you correct them, and you do the whole process again. So it is fairly systematic, right? It's not as simple as just, listening to someone talk and they say, oh, look, I really like this stock, and that sparks your fancy, so you research it, and you think it actually does look quite good, so you buy it. I mean, that can work, but typically it helps to be more systematic, because if you're more systematic, it's easier to find out where the weak points are. It's easier to continue in the past the way you have, it's easier to continue in the future the way you have in the past, and so on. And that's particularly true of funds because it's not always the case that the same manager will run the fund through time. Right? Some funds have fairly high manager turnover. Now, if that fund is going to continue to outperform, the only way that's possible is if they continue to bring in good managers that can keep the same process going through time. Any questions so far? So hopefully a lot of this feels like common sense to you. It is common sense. But I just want to drive home the fact that you really do need to go through the time before you even touch a trading account. You need to sit there and start to think, why do I want to trade? How do I want to trade? And do all of the due diligence and research ahead of investments actually taking place. Okay, so let's say that you have an investment process. There's a huge range of features that an investment process can have. They differ along a number of different lines of analysis and dimensions. Here's a whole bunch that I'm just giving you as an illustration, and then we're going to look at a few other ways to break up the investment process too. We're going to look at skill versus breadth. We're going to look at the importance of tracking error. So what I want to do for this next part of the lecture is just to give you guys an idea of the wide variety of investment processes that are out there. We're not going to look at any one in great depth. It's a case of understanding the breadth of it rather than the depth of a particular one. I'm guessing pretty much all of these you guys would have covered in prior courses, but one of the ways that investment processes can differ is whether you take a bottom-up or a top-down approach. If you're going to take a bottom-up approach, actually, let me start with top-down, and that might put it in perspective. Let's say you take a top-down approach. It is exactly as it sounds, which is the problem with bottom-up, which isn't. In a top-down approach, you start with the biggest top picture, and that is the economy. You say, what is the economy going to do over my forecast period or my investment horizon? When you have an idea of economic trends, you say, well, given that performance, given the way the economy is going to go, what industries are going to do better, right? So you start with the economy. Once you've got an economic prediction, you move into predicting outperforming industries based on that economic prediction. Once you figure out what industries are likely to outperform given the state of the economy, only then do you go about picking stocks within those industries. So you are picking stocks, but it's not the primary focus. The focus is what the economy is going to do, and therefore which industries will outperform, and therefore which stocks will outperform. So, for example, you might have predicted that China was going to go through the economic boom that it has over the past, many years. If you predict that China is going to go through an economic boom, you say, well, I'm an Australian investor, I'm running an Australian equity fund. What industries do I think will profit from that economic boom? And you might focus on resources, right? Australia is close to China. We have a strong resources industry. That will mean that there's likely to be a high demand for exporting our resources to China. Only then do you say, all right, well, I'm focusing on the resource industry. What resource stocks are best positioned, not just are best in general, but best positioned to benefit from the fact that the resources industry will do well because of the economic boom in China. Right, so it all starts from the top and filters down. The reason I don't like the phrase bottom up is it implies that there is an up, and there isn't. Right? Bottom up is stock picking, pure and simple. You don't care about what's happening in the economy. You're not focusing on what industries will do well. You're looking at what stocks are strong stocks with a good business model that will, and you're arguing that at the end of the day, a good stock in the long run will be a good stock, irrespective of what's happening in the market, irrespective of industry trends. You're looking for stocks that will have value and that will therefore override the fluctuations of the market through time. So it's called bottom up, but it is just bottom. Yeah.
So the process is basically...
Sorry?
Is the process basically what I do?
All of these are, yes. Passive is essentially, it's a very unique type of process that's very easy to follow, right? Because the philosophy is I want to be diversified. The signal is, oh, sorry, I forgot. The question is, these are all active forms of processes. Sorry, that's for the recording. Yeah, so if it was a passive process, the philosophy is, I believe in diversification. The process, if we go back here, Well, what tells me to trade? What tells me to trade is that the composition of my underlying index has traded. What trades do I put on? If there's a new stock coming into the index, I buy it. If there's a stock that leaves the index, I sell it. The paper portfolio might differ from the actual portfolio in performance because even in a passive investment, if the stocks are illiquid, you're likely to have transaction costs. So that's a very specific type of process that really there aren't that many different ways to go about it. Whereas what we have here are lots of different active forms of investment, and each of these different dimensions could end up in a very different looking portfolio coming out at the other end. The next way that you could break it up, again both active, is am I going to generate alpha through security selection or market timing? Market timing is very close. It's not exactly the same, but it's quite similar to one of the top two, bottom-up or top-down. Is market timing closer to a bottom-up or a top-down strategy? Top-down, right? Because market timing, what you're doing is you're trying to look, you're forecasting the overall economy to figure out whether the, say, equity market is going to go up or down. And that is going to drive every one of your decisions within the process. Okay, so the difference is both top-down and market timing starts with the economy. In market timing, you're not focusing on industries. What are you focusing on? What's going to tell you whether to buy the stock or sell the stock in a market timing on equities? Beta, right? Exactly. So let's say that you forecast that the market is going to rise in the future. If that's the case, you will tilt into what type of beta stocks? If the market's going to go up. High beta stocks, so then when the market goes up, your stocks go up by more. If you predict that the market will decline, you go into low beta stocks, or ideally no or occasionally negative beta stocks if you can find them. The key being, as long as the beta of those stocks is lower than 1, lower than the beta of the market, when the market falls, you might fall a little, but you'll fall by less. Okay, so you're forecasting the economic trends and you're deciding what stocks to therefore investing based on the beta of those stocks and how they correlate with the market. Security selection is very similar to bottom-up, right? It's stock picking. You're not focused on the beta of the stocks. You're going to analyse each individual stock to look for stocks that you think have a strong value, a good business case, good fundamentals, not too much leverage, whatever is actually in your investment process. But you're not basing it on a view of trying to capture market trends. You're trying to find a stock that has inherent value that you think will override those trends. That doesn't mean you completely ignore the market necessarily. I mean, if you look at a stock and it turns out that they do have a high correlation with the market, then of course you should therefore consider the market movement. But that's because it's a feature that's unique to that stock and how the stock will behave. You could look at a fundamentally driven process or a technically driven process. Now, in a fundamentally driven process, the key is figuring out how you value a company. The view is that there are times where intrinsic value will deviate from actual market prices. And if you believe that you are good at understanding the intrinsic value of a stock, then if you find that the firm has a lower intrinsic value, so if you think the firm is undervalued compared to the market, what will you do? Buy. And if it's overvalued, you sell. It really is that simple. What isn't simple is the process of actually finding intrinsic value. You might do something like a discounted cash flow analysis that is very sensitive to assumptions that you make, and therefore if you are not good at making those assumptions, if you're not good at analysing the different line items, you might do very poorly. But if you're skilled, it's all about understanding the company, their strategy, the annual reports, the management team, and coming up with a view of what you think that company is worth. So it's your own personal view. A market or a technical-driven strategy has no interest in how you value a stock. What a technical strategy cares about is how the market values the stock. Right, so this is things like charting to capture price momentum. So things like price momentum, if a stock has been going up over the past 3 to 12 months, the strategy will tell you it will continue to rise over the following 3 to 12 months. None of that has to do with analysing the company or you getting your own value through a discounted cash flow analysis. It all has to do with looking at a chart and following the lines on that chart because you think that overall market participants have certain behavioural traits that you want to take advantage of. There's subjective versus quantitative. So if we keep this with fundamental and technical and subjective and quantitative, is subjective analysis more likely to be used in a fundamental or a technical strategy? Fundamental, right? So these processes are not always exactly the same, but the reason I'm drawing parallels between them is that where there are similarities between the definitions of these processes, you're more likely to come up with a similar looking portfolio. And that's going to become important later when we talk about making sure you have managers that aren't too highly correlated if you're going to have a multi-manager portfolio. So subjective, you're incorporating your qualitative analysis to form a holistic view of the company. Right, so you are using soft information here. You're going and attending the annual general meetings, you're talking to management, understanding a rollout strategy. It's something that it doesn't rely just on the numbers, it relies on how you interpret the numbers because you're creating estimations to go into the valuation. A quantitative is far less subjective. You might have an overlay of common sense. You know, if the model tells me to buy, does that seem like a really dumb decision? But at the end of the day, what you're doing is creating numerical models that are going to have data that's automatically inputted into these models that will run through the calculations and pop out an undervalued or an overvalued assessment at the other side. Now, these are all proprietary models that should be constantly being updated as markets change. But it might be looking at things like price momentum, earnings revision, leverage, dividends, all numerical things that you can analyse numerically. You're going to be running regressions. It's funny, in quant funds there tends to be a lot of... so when I was at Schroders, I spent an internship in their quant fund. I was one of the only finance people that had that internship. A lot of the people in the fund were like astrophysicists and things, because what they're doing is they're working with computers. They're working with models. It's not about the underlying financial intuition. It's about making sure that you've got these really deep methods of simulations, for example, that are going to spit out a numerical result. And then the fund manager that sat on top of this fund was known for having an innate understanding of the markets and occasionally going, hang on, your model's told you this, it doesn't look right, and will occasionally override the decision. And that's important as well, because remember, a computer doesn't have its own common sense check. Okay, but they're two very different lines of analysis. They'll end up with two very different portfolios. And then there's also, are you going to focus on a short or a long horizon? If you focus on a short horizon, you're focusing on trading. You're trying to find short-term market mispricing that will quickly correct, which means you're going to have a much higher turnover. If you're focused on a long horizon, you're looking at investing in stocks that ideally are slightly underpriced now, but more importantly are high-quality stocks that will continue to perform well for a long period of time to generate those returns for your portfolio. Okay, so I'm guessing most of these are relatively familiar to you. What might be less familiar to you is another way of breaking up your investment process, but this time splitting it into two concepts that we call skill and breadth. And this is the fundamental law of active management. I really like this theory because it gets sort of to the heart of how much faith you have in your ability to generate outperformance, and more importantly, helps to guide you into a way where you can improve your information ratio, not by demanding that you have 100% accuracy, but by ensuring that the method through which you form that portfolio is using different lines of analysis, and therefore you're choosing stocks for different reasons. They're not all positively correlated or highly positively correlated. So let me explain why that is. What the fundamental law of active management says is that the active returns of a manager can be split up into two different sources. One of those sources is skill. Skill is how well you trade. Now, an active manager that has a negative skill, which is defined by the information content, shouldn't be an active manager. You need some skill, right? So the information content, which It's actually very difficult to measure, which is why it's still often used as a theory more than a specific calculation. But the information content should be positive or you shouldn't be active at all. But assuming it is positive, if it's positive but not particularly high, you can still actually produce a strong performance by increasing what we call breadth. So skill is not only how often am I right, but do I put my money where I'm right most of the time. So it's a magnitude and percentage of your successful trades. Before I go into breadth, let me talk about why those two are important. You want to be right more often than you're wrong, or you don't have skill in picking stocks. So that's the percentage, right? To be skillful, you would hope that over half the time, the stocks you believe are undervalued turn out to be undervalued. But on top of that, it's no good being right 90% of the time and wrong 10% of the time if you end up putting 90% of your money in those 10% of stocks where you're actually wrong and they're undervalued. So you should be right more than half the time, and you should be putting your money in those, not all the time, but you should be putting at least the same proportion of your funds in the stocks in which you are right. So if you have an equally weighted strategy where you equally weight all of the stocks, then it only comes down to the percentage of successful trades, but otherwise it's also the amount you put in the trades that are successful. So that's skill. Breadth is how often you trade. So at any one particular time, how big is my stock portfolio? How often am I going to turn over that portfolio through time? How often am I going to add in new investments versus removing investments? So what the fundamental law says is that the information ratio is equal to the information content times the square root of n. The information content is your skill. The square root of n is your breadth, where n is the number of independent bets per year. The same two different managers can have the same information ratios even if they are not equally skilled. And that's because the manager that is less skilled can improve their information ratio by increasing their breadth. So probably the easiest way to understand this is by way of an example. I'll give you two. Let's start with two stock pickers, just because that's... let's start with two stock pickers. Let's say that you guys are your managers, and you are right 55% of the time. So 55% of the time, the stocks that you believe are undervalued are undervalued. That's not a great hit ratio, right? But let's say that everyone on my left, you guys are only buying one stock. Everyone on my right, you're purchasing 100. You guys that are only buying one stock, you've got a 55% chance of success. You're buying one stock, so you're not going to feel particularly confident that your portfolio of one stock is going to have a good return. The people that are buying 100 stocks, better yet 1,000 stocks, the more the number of stocks goes up, the more certainty you'll have. But if we stick with 100, with 100 stocks and a 55% success ratio, every one stock only has a 55% chance that you're right. But you can start to be much more confident that you are going to have 55 successes and 45 failures. What happens is central limit theorem kicks in. So if you have 1,000 stocks, you can be even more confident that you're going to have 550 successes and 490 failures. And that's going to lead to a profit overall. So with the same 55% chance of success, with only one or a few investments, you don't have a lot of confidence that you'll produce a positive return. But with many, because of central limit theorem kicking in, you're going to start to have a high confidence of a small profit, even with only that little bit of skill. Does that make sense? If you had, say, a 90% probability of success, then you can start to be more confident in a strategy where you're only going to pick a few stocks. Because with a 90% success ratio, that is much more likely to translate into a positive return overall. You don't need central limit theorem to protect you. So if I turn those into a particular spectrum of strategies that we've done before, This is interesting because it's often something that people don't immediately think of, and that's the difference between stock selection and market timing. Let's split it up again. Let's say that everyone on my right, you guys are market timers. Everyone on my left, you guys are stock selectors. You each have a portfolio of 30 different stocks. So technically N seems like it's going to be the same. 30 stocks, 30 stocks. But my stock selectors, you guys have a fundamental strategy where you're driven by a value focus that you're putting into discounted cash flow analysis, but you have a big focus on the business case of the company. You look at SWOT analysis and Porter's 5 forces. You try to get a spread between different industries. So even if you find, you might find 15 undervalued stocks, if you're only going to invest in 5, you'll make sure that they are from different industries to give you that diversification. Right? So through that process, you come up with 30 stocks. My market timers, you've got 30 stocks. You expect the market's going to rise. So why did you pick those 30 stocks? High beta. That's it, right? So when you talk about the number of bets, if the market goes down and you guys are wrong, what's going to happen to every one of your stocks? It's going to drop by more than the market, right? So even though you have 30 stocks, they're not independent. It's sort of like you've made one bet because you've chosen every one of your stocks for the exact same reason. There's no breadth there. Whereas the stock selectors, you guys have looked at different industries. You've looked at each individual company, and every company is going to have a different business case, a different management team, a different competitive advantage. So that if you're wrong in one of your stocks and it goes down, it doesn't necessarily mean the other ones will. You've got diversification amongst your different active bets, which means that from a breadth perspective, you've got diversification reducing the risk that you'll end up with a negative return overall. Okay, so it's not just about the number of stocks you hold, it's about the fact that those bets need to be independent. And all else equal, if you want the same information ratio, if you don't have breadth, you need a very high level of skill. But if you do have breadth, you can get away with less skill to generate the same amount of outperformance. So that means that you can essentially outperform by a small number of large and correct bets, that's a skill focus, or a large number of smaller bets that are not always right, but they are right on average. And that's your breadth focus. But remember, the key is that those bets need to be independent. So we're going to go through in a couple of slides a number of different examples. Always remember the importance of the independent bets. It's not just enough to look at the number of stocks in the portfolio, it's about how those stocks were chosen and therefore whether they're likely to be highly correlated in their returns. So this is a pretty cool strategy because you don't need to be right all the time. You just need to be right on average, providing you have breadth to protect you. Now, as I said before, that said, some skill is always required, right? If you have a negative information content, stop trading. The more breadth you have, the more damage you're going to do if you're genuinely not going to pick good stocks, right? Playing the pokies again and again and again is not a better strategy than only playing them once because the odds are against you. But with a little bit of skill, you can leverage that to get greater information ratios by increasing your breadth. Now, there are some managers that will be highly skilled and have diversified portfolios. So you can have skill and breadth in the same portfolio, absolutely. But in terms of whether you were going to focus on one or the other, each of them will have advantages and disadvantages. Funnily enough, in terms of the advantages of going for a breadth focus, it's actually easier to prove that you're skilled if you have a strategy with good breadth. And it comes down to how you justify, how you create confidence in your investors that that performance can be repeated. Because remember, that is the key of an investment process. You need to give confidence that if you've done well in the past, you'll continue to do well in the future, and it wasn't due to luck. If you've made 1,000 trades over your history, your track record of 10 years, and you can say, look, I'm not always right, but 750 of my 1,000 trades made money, then from a statistical perspective, you can start to have confidence that there is skill there to bring the success ratio above 50%. If you've only made one purchase, and it did pay off, if you bought A2 milk back in the day before it had its massive ride of success, but that's all you've ever done, it's harder to convince someone through statistical analysis, even through reasoning, although at least then you can talk about your investment thesis. But statistically, it's harder to convince someone that you are skilled, because how do I know that you weren't just lucky? Yes, your bet paid off, and therefore, yes, you've made a lot of money. People that invested early on in A2 milk have made a lot of money from it. But how do I know that you just didn't happen to pick it and luck was on your side? Okay, so it's easier to prove that you're skilled by having sufficient breadth in your portfolio. And the other thing is, with sufficient breadth, diversification actually reduces the risk, because you're not relying on a single factor that will either mean that your portfolio is a success or a fail, right? And that comes back to the market timing stock selection example. Stock selectors, if you have breadth in your portfolio, then just because one stock goes down doesn't mean the rest will. Market timers, if the market goes down, it will bring down every stock with it. That said, if you have a breadth focus, you're trading more, and every time you trade, you have transaction costs. That's going to eat away your return. So that's one of the big disadvantages of breadth. And the other one that sort of is, it goes ever so slightly against what the formula appears, but it makes perfect sense in reality, is that if you really want to blow the roof off on your performance, you're not going to do it through a portfolio of high breadth, because even among the winners, there are better winners than others, right? So let's say that you've identified the 50 stocks, the 50 top performing stocks over the next year, right? And you are right. So ahead of time, you are about to consider buying 50 stocks that will outperform all of the others in the market over the following year. Those 50 stocks, though, are going to have a ranking within them. They're not going to have the exact same return. So if you knew that you were correct, and you knew those top 50 stocks were the best stocks, and you knew the ranking, and you wanted as high a return as possible, would you take all 50 stocks, or would you take one stock? Which one? The highest, exactly. So at the end of the day, if you really want that performance that no one will ever forget because it was so huge, if you want the long-term capital management performance before they went bust, that tends to happen through skill, not breadth. Because the second you have breadth, even if they're all positive alpha stocks, they'll be diluted because some will have lower alphas than others compared to if you only took the very top stocks. But if you're wrong and you focus on skill, not breadth, and that top stock wasn't a top stock and went down, well, you've now lost a large chunk of money on your portfolio, and you might lose a lot of your investors as well, which goes back to the fact that breadth is lower risk. Okay, so I really like that way of looking at your strategy, because it means that you, even if you're the same manager going through time, you can start to look at your confidence in your predictions and say, well, all right, if I'm not hugely confident that all of my bets will pay off, do I have enough breadth to help me out? And that might say, you might sit there and go, maybe I need a bit more diversification. Yeah. 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 Yeah, that's true. That's true. I mean, if you're running a fund that's the question is that investors' constraints may actually reduce the information portfolio simply by constraining the manager's ability to go for breadth. I mean, yeah, if you're running a fund that's constrained to a particular industry, that very constraint is absolutely going to limit your information ratio. I suppose there's two things. Within those constraints, it's a case of doing the best within the constraints that you have and hoping that your evaluation will be against like managers. So typically, if you're in a utilities fund, you'd be evaluated against other utilities managers with similar constraints. But the other thing is, if that's the case and an investor is aware of this and choosing to invest in you, they might have chosen to invest in you because they believe in your skill, and they might themselves try to get breadth by investing in other funds with different constraints as well. But it is true. I mean, sometimes you might not be able to control the full extent of how much breadth you can get in there, but you can still, if you believe that you need breadth to diversify your bets, go for as much bets within the constraints that you're allowed to do.
So we are talking about the opportunistic, the best return you can get.
That's right. That's right. Yeah, within the context of your constraints. And that's a good point. And look, when we talk about multi-manager investing as well, I mean, the view of multi-manager investing is that you should let the manager focus on what they're best at and get in the diversification yourself. But that does imply that you're picking managers with a high skill. Any other questions? Okay, so here's a few different examples that mean that we can start to get an idea of, if you look at a fund's investment process, are they relying on skill, breadth, or a combination? And remember, you always need a little bit of skill. It needs to have a positive information content. But once it's positive, are they going for a lot of skill or a lot of breadth, or both? So here's the first one. We've got an asset allocator. So this is a big portfolio that is engaging in strategic tilting. So occasionally they are shifting away from their static asset allocation because the markets are at an extreme. Now, what I probably should have done is let the answers pop up bit by bit, but given that you print it off, I always feel like there's not much point. But let's talk not about what the answer is, but why. The answer is this is almost exclusively skill. There are two things to suggest it, that there isn't any breadth in this exercise. Can anyone tell me what's one of them? Why is this skill not breadth? Occasional, yep, that's the first one, right? So you're occasionally tilting, right? So an asset allocator, you're not going to have a very diversified tilting strategy. You're saying, am I going more in, an equity ETF or less? But that's a single decision to do. So you've got occasional tilts, so your number is low. And what's the other thing here? Extreme markets, exactly. So it's like the market timing example. You don't have diversification within the number of bets. So you only have a few different, so your breadth is low because you only have a few bets going on here, and they're all happening for the same reason, right? It might be that because you think the market is going to boom, you will go more heavily into equities and less heavily into fixed income, but you're doing both trades for the exact same reason. All right, the next one is an active stock picker, right? And remember, we do say that typically, on average, stock pickers are actually relying more on breadth than your market timers. But here, we have an active stock picker with a tracking error of 7 to 10% that holds 5 to 10 stocks. So the reason I wanted to include this one is the example I gave is not always the case about market timing being skill and stock picking having more breadth. If you're given further information in a question, you need to analyse that information to check that that result still holds. Right? If the question just says what's more likely to rely on skill and what's more likely to rely on breadth, stock selection or market timing, then you can say, well, market timing is more likely to rely more on skill, stock selection is likely to rely more on breadth. But here, we have more information that's actually starting to change the circumstances of this case and therefore the answer. The first one is a tracking error of 7 to 10% is really high. Right? I mean, a high tracking error would be 5%. If you're diverging so much from your market that you have a 7 to 10% tracking error, that is a very concentrated portfolio. So there's no breadth there. The second is you've only got 5 to 10 stocks, right? So it implies a concentrated portfolio where your bets are likely highly correlated because you've got a high tracking error, so you don't have diversification, and your number of stocks is really low anyway, right? A 5 to 10 stock portfolio is small. Okay, so even though it's a stock picker, we're still moving towards a skill focus. And that comes back to the fact that remember how I said if you picked one stock, you're relying on that one stock bet paying off. Here we've got 5 to 10, but they're probably highly correlated because we've got a high tracking error and you're not going to get, therefore, a lot of diversification within it. Does that make sense? So always look at the details of the question before you make the conclusion. Now, we've got a quant equity fund that holds 50 to 60 stocks that are turned over often. This is your classic breadth focus. Your quant equity fund, your models will have a number of different factors included within them. You saw an example, for example, with Miski Barra in week 6. 50 to 60 stocks gives you a high N. High turnover further increases your breadth or your N because you're going to have stocks entering and leaving at different times for different reasons. And because you've got a multi-factor quant model, you're going to be choosing stocks because they're appearing cheap on different dimensions as well. So you need a little bit of skill, but not as much, all else equal. Fixed income manager that forms their portfolio just on a view of interest rates is skill. This is the equivalent of what within equities out of what we've looked at? Would that be closer to stock selection or market timing, but in the fixed income universe? Market timing, right? Because your view is not about the individual fixed income securities, it's about your view on interest rates, right? If, for example, you might focus on duration based on whether you predict interest rates are going to rise or fall, or just whether you buy or sell bonds as a result, but it's all based on the interest rate direction. Now, a fund of hedge funds is more breadth, but some skill. Now, the reason that we say it's more breadth is that a fund of hedge funds will invest in about, well, let's say 5 to 7 maybe different hedge funds. Each of those hedge funds will have a portfolio within which are a number of different securities. And particularly if those hedge funds are pursuing different strategies, that's going to give you breadth, 1, through the number of end investments, and 2, because the different hedge fund managers are pursuing different strategies for different reasons, and you have a large spread across the hedge fund universe anyway. Remember, that's one of the first things we said about hedge funds. Their strategies will vary cross-sectionally, and they'll vary through time. So you have a lot of breadth there. Most of the skill is actually going to be in the hedge fund manager, not the fund of hedge fund manager, but you still do need some skill as a fund of hedge fund manager because you need to pick the outperforming hedge funds, right? Not every hedge fund will end up giving you alpha. A traditional private equity fund, so this isn't a private equity fund of fund, this is the actual private equity fund, is more skill, but does have some breadth. Now, more skill because obviously, remember, with private equity, this is one of those investments where there's scope for economic value add. Right? The general partner is the one that comes in and turns around the company and drives the value creation themselves. It might be taking a public company and turning it private to make it more efficient, or it might be taking a startup company, taking the product through to fruition and turning that company public. Right? But either way, it really relies on the skill of the general partner. I've said some breadth. Now, if we go back up to the active stock picker that has 5 to 10 stocks, I set up there that there's very low breadth because there's also a high tracking error, and in a traditional active fund, that's a small portfolio. Now, a private equity fund would also probably only have between 5 and 10 stocks, but there's greater breadth within those stocks. Can anyone tell me why that would likely be with a private equity fund? Yep, different industries, that's right. So there'll be different industries, there'll be different processes to create the value creation, to drive the value creation, and private companies have a lower correlation anyway because they're not subject to the whims of the public equity market. Right? So even though there may be the same number of stocks with private equity, the returns will be less highly correlated. They'll be being realised at different times. You're not going to take every private equity company public at the exact same time within your portfolio. Right? So the returns of the individual investments within the private equity fund are going to have lower correlations as a result. So there isn't a lot of breadth, but there is more than you'd expect in a traditional public equity fund by nature of it being a private investment. Any questions on those? All right, so let's take a break and then we'll come back and have a look at tracking error and then we'll move into multi-manager investing. So it is 3:15. Let's come back at about 3:20. Okay, so the next couple of slides are really just repeats of what we've done before, so I won't spend a lot of time on them, but I wanted to put them here to keep them in the context of what we're doing today. So we've already looked at tracking error, we've already looked at things like value versus growth, but as much as possible, one of the arts in this course is bringing the different weeks together, and what we've done in those other weeks is very relevant to the investment process as well. So just to quickly recap, why does tracking error matter in terms of understanding a fund's investment process? Well, for example, the more active the fund is, would you expect a higher or a lower tracking error? Higher. So let's say that you're trying to understand a manager's investment process, and a manager claims to pursue a very active strategy and therefore charges high fees. And you have a look at its tracking error, and it's 0.1% against the benchmark. Is that an active fund? Barely, right? I mean, essentially they're calling themselves, and by the way, this happens, they're called closet indexes. They call themselves active, they charge fees for being active, and all they really do is hug the benchmark, because then at least they don't underperform, right? So they get the fees, the end investor does underperform after fees, but they never really have a big negative alpha because they're basically doing the same thing as the benchmark. And it's quite scary how many of these funds continue to exist. It seems like investors aren't picking that up and taking their money out. Probably partly pretty clever marketing on the manager's behalf. So one of the things you want to do when you look at a process is see whether the tracking error is as it should be given the process they describe. So tracking error is the estimated standard deviation of returns around the benchmark. Within the context of equity, as opposed to the asset allocation level, like you look at in the assignment and in prior weeks, what you do is you take the returns of the equity manager, subtract the returns of the equity benchmark, and take the standard deviation of the difference. Or the same thing in a fixed income world or a property world, and so on. So that's that first measure that you guys do in this course. Other measures that you don't do in this course, well, you could actually regress the returns on the benchmark and take the standard error from the model as a measure of tracking error. Or you could predict what the tracking error will be by predicting the returns of your fund and the returns on the market based on something like the Barra model that you do in Lecture 6. But we don't actually look at either of those in any depth here. I'm just including them for completeness. Right, so there's no right level of tracking error. It's not necessarily true that the higher the tracking error, the better, because the higher the tracking error, the higher the risk of underperformance as well, particularly if you don't have skill. But you also don't want tracking error to be very low if it's an active fund, because there's no point paying high fees to a manager that is just going to hug a benchmark, right? You could get the exact same returns for far lower fees by investing in a passive fund instead. So typically people argue for a sort of sweet spot in the middle. We say tracking errors of under 2% are low, 5% plus are very high. Unless you've got a lot of confidence in the manager, people feel a bit safer with a tracking error maybe in the 3 to 5% range. But some of the best managers that have done the best, remember, if you go back to that skill focus of blowing the lid off the performance, if you're going to have absolutely brilliant returns, it tends to be done through a concentrated portfolio, and then the tracking error will be very high. But some of the worst performers have had high tracking error as well. So what we're going to look at with multi-manager investing in a couple of slides is the fact that if you can find lots of good managers that are active and therefore have high tracking errors, by spreading your money between them, you can keep the average alpha of that group of managers, but lower the tracking error below the average of each individual tracking error. The other thing we looked at in week 6 was investment styles in the way they're defined typically in the US. So value versus growth, capitalization styles, so large, mid, small cap, and market-oriented styles. In Australia, it is harder to separate funds by their style. The reason is that in the US, if you have a value fund, it will be called a value fund and typically benchmarked to a value index. In Australia, there's a larger proportion of funds that are benchmarked to broad indices. So even if you are a value fund in Australia, if you're trying to keep your tracking error within acceptable levels because of a mandate, for example, You can't just invest in value stocks necessarily if that's going to cause a too big a tracking error. So there are styles in Australia, but they don't tend to be as extreme as what you see in the US, where you'll have funds that only invest in a particular universe of small caps or a particular universe of growth stocks. Now, in terms of why style matters in the context of today, we're about to go into multi-manager investing. And remember, the key there is like diversification with stocks. You find a number of high alpha managers and you spread your wealth between them to keep your alpha equal to average alpha, reduce your tracking error risk below the average tracking error. When you looked at diversification among stocks, what was the key metric that you looked at to ensure sufficient diversification between when you add a new stock into a portfolio? Sorry? Covariance, exactly, right? Covariance, correlation, beta, whichever metric you want to check. You want to make sure that the different stocks weren't too highly correlated with one another. The exact same thing happens with multi-manager investing. If you're going to spread your wealth between different managers, you don't really want 5 very good value managers, right? Because just pick your best. To actually really get rid of the style exposures, you want a good value manager, a good growth manager, a good small cap, a good large cap manager. Because then they're going to have lower correlations, which is going to keep your average alpha and reduce your tracking error by more. And I'll give you a numerical example in a couple of slides. Okay, so how do you identify styles? Well, one of the things is that they might tell you what they are through their philosophy and their process. To confirm that that is the case, you might want to look at the return correlations between different funds. You might want to look at the stocks in their actual portfolio and whether they tend to be value or growth in nature. Or you might want to regress the returns of the fund on, say, a Farmer French model and see whether the different funds have similar loadings on the size factor or on the value versus growth factor. And through looking at all of these different dimensions, if your goal is multi-manager investing and you're trying to find different types of managers, you can check that the funds you invest in are not all doing similar things and therefore holding similar portfolios. Now, that said, though, there is, if you carefully look at the process, the investment process, there is scope to put your money with more than one value manager or growth manager or quant and so on, providing they are doing slightly different things in trying to find their value stocks. So there is still a potential for diversification within a style pool. And the reason is that their processes, even within a category, can be quite different. So here's an example of that. Let's say you want to find some value managers. Now, value managers aim at identifying undervalued stocks with the view that in time, the market will realise their mistake. So they buy them while they're out of favour with the market, and then they enjoy the price increase when the market realises that they are of higher value than they believed. Process A, you are tilting your portfolio towards stocks that are classified as value using 2 different metrics. One is price on earnings per share, and the other is price on book. And when you do that, you're going to do it on a sector-neutral basis. So you're trying to find cheap stocks, but you're trying to find the cheapest tech of the tech stocks, the cheapest banking of the banks, the cheapest resource stocks of the resource industry. So by doing that, you're going to get a spread of exposures across your different industries. Process B, you've got a different, I'm just picking these as an example, a different value metric. It's price over 3-year forward sustainable earnings per share. And you're using that metric, ranking every stock in the universe and just picking the cheapest 20 to 30 stocks. Process B may not have industry diversification like Process A. So the benefit of Process A is that you're starting to get rid of some of your concentrated exposures within a particular industry because you're trying to be sector neutral. But if you're getting, and it's the same thing as the skill versus breadth argument, it's why I like it so much, everything can come back to this. If you're getting the cheapest techs of the techs and the cheapest resources of the resources and the cheapest banking of the banks, you're not necessarily going to perform as highly on a return basis as if you're just buying the cheapest 20 stocks, right? Because it might be that banking is relatively overvalued compared to the resource industry. So even though you've got the cheapest of the banks in general might still be overvalued. Okay, so the benefit of process A is a sector diversification. The benefit of process B is if you're right in getting the cheapest stocks, the returns should be higher because it's unlikely that those 20 to 30 stocks will be perfectly spread across every sector. A growth, well, here you're trying to find stocks where their growth will outstrip the growth rate in the overall market. Here's another two examples. One is the process A for growth is more traditional. You're just buying stocks with the fastest revenue growth while imposing screens to avoid low-quality stocks. So maybe you might have a governance screen, for example. You might have an ESG screen. Or process B is not your traditional growth metric in that you're ranking stocks based on return on capital, the industry they're in to get a good spread, looking at the quality of management and putting it into a 20-year DCF. That's not what you typically think of when you think of a growth strategy, but you can still follow that process with the view of trying to find stocks that you think will have strong growth potential in the future. If you're a quant strategy, you might use some kind of proprietary multi-factor model like the Barra models, or you might be based on charting or technical rules like following a price momentum strategy. So within each of these buckets, different processes can actually mean that the returns, it breaks down the high correlation in the returns, and you might end up with different looking portfolios. So there is scope to have more than one value manager, for example. But to do that, if you want diversification, they should be doing different things. So that leads us into our multi-manager investing. Hopefully by now, because I've been sort of bringing it up as we've gone through the lecture, you guys are probably pretty much already across what this is going to involve. Right? If you're a manager with a pool of money and you're going to allocate that first between different asset classes, and then within an asset class, within different managers, how do you pick which managers to give the money to? Right? So you've got 20% of your fund in world equities. You want to take that 20% and you want to put it in 5 different external active managers. Right? Multi-manager investing is really important when they're active, less so when they're passive because you've got the diversification inbuilt. And you're never going to get alpha out of a passive strategy. All right, so the goal is to improve the risk-return trade-off from investing in active funds by spreading that investment between different managers. When you do that, you aim to diversify your idiosyncratic manager risk. Right? The second you become an active manager following an active strategy, you are not fully diversified. So you do have idiosyncratic risk. By spreading your wealth between different managers doing different things, you're better able to diversify the idiosyncratic risk of any one manager. You try to get rid of any unwanted style exposures in your portfolio. So, for example, let's say you have a really good growth manager and a really good value manager. This is from your Excel video 5. Remember what we saw is that overall value outperformed, but it went through sharp periods of underperformance. If you have a really good growth and a really good value manager, each will give you alpha, but when the value factor is doing poorly, even if it's a good value manager, it won't be doing as well as a good growth manager, and you've got a good growth manager in your portfolio as well. Right? So it starts to get rid of a style concentration. But of course the key is that those managers have to be good, right? Because you're going to get alpha equal to the average alpha. And if you have half of them being positive and half of them being negative alpha managers, then you've just got rid of your alpha overall. Right, so how do you figure out whether you do have a good spread across different styles of managers? You could look at the correlation of their returns. You could regress their returns on factor loadings through things like the Farmer-French or Carhart model. You could look at the attributes of the actual stocks within their portfolios, or you could look for overlaps in their investment process. So see, that's exactly like what we said by how you identify the style itself. Identify the style of each manager, check they're not all of the same style. Now, the one downside or a particular downside of this multi-manager investing is that you're giving your money to separate managers and they're not coordinating with each other. So the risk is that you've given money to a value manager and a growth manager. And the value manager decides that Telstra is no longer a good investment and they're going to sell it, around the same time that the growth manager decides that Telstra is a great investment and they're going to buy it. It's plausible, and what would happen is you had Telstra in your portfolio, you still have Telstra in your portfolio, and you've wasted a double layer of transaction costs. Right? So the risk in doing multi-manager investing is that you're going to have inefficient transactions. Let's say that two managers both hold BHP shares in their portfolio. One manager wants to sell them, and they've only held the shares for 3 months. Another manager bought those shares at a similar price, but has held them for 3 years. That manager doesn't want to sell the shares. The cost basis is the same. We're going to look at this next week. Cost basis is the same. You should not sell the shares that you've only held for 3 months. Why is that? What happens when you sell a share that you've held for less than a year versus more than a year? Capital gains tax, right? If you're going to sell BHP shares, two managers have them in their portfolios, the cost basis is the same, so the capital gain is the same. You want to be selling the one that's going to get the capital gains tax discount because they've held it for more than a year. So you want to sell those BHP shares and essentially take the other BHP shares and transfer them across to the other manager that didn't want to sell them. That is what overlay portfolio management enables you to do. If you have multi-manager investing, an overlay manager can sit over the top and check that none of those inefficient transactions take place. Right? And the most extreme form of it is that the managers don't actually execute the trades. They decide what they want their trades to be, feed them to the portfolio manager, and the portfolio manager checks that every trade is done on the most efficient way for the fund overall, rather than each individual external manager's portfolio. So it costs, of course, there are fees, but it minimises efficiency and it can save you a lot of money. So what we have here is a numerical example that will just it serves to drive home the benefits of multi-manager investing from a diversification perspective. I've made up these numbers to illustrate my point, but I have got them mimicking the styles of the different strategies. You can see values in blue, and as what tends to happen with value, it does particularly well when the market's down, less well when the market's strong. Growth is in green and tends to be the reverse. And thematic doesn't really follow. It follows whatever strategy happens to be profitable or they think is profitable at the time. A thematic manager is quite hard to pin down their exposures. So they're sort of sitting somewhere in the middle. We've got all three managers have at least a 0 or positive alpha. None of them are negative. The value manager has a 2.8% alpha. The growth manager has a 0% alpha, the thematic manager has a 1.4% alpha, and they all have identical tracking errors of 4.5%. Now, in the middle, the black shows you combinations of two of the managers, but what I want to focus on is the green. When you combine all three managers, and this is done with actual data, what you get is you have an active return equal to the average active return of all of the managers, but you have a tracking error well below the average tracking error of the managers. Right? The average is obviously 4.5 because they all have the same tracking error. So if you think about your information ratio, which is the active return divided by the tracking error, the information ratio for the combined portfolio of three managers is way higher than even the most successful manager up the top, which is the value manager. Okay, so, all right, the alpha is only equal to the average alpha of them, but the tracking error is significantly reduced below the average, so the information ratio is improved for the portfolio. Okay, so you have average alpha, but below average tracking error, and then the only thing that is really important is that you want those managers to have a 0 or positive alpha. You don't want them to have a negative alpha. And ideally, all of them having positive would be better. Yeah.
Actually, the low tracking error doesn't mean we are covering just more assets.
Sorry?
I mean, the tracking error is low.
Yeah.
Doesn't necessarily mean we are covering more assets under different managers.
It does. It does. So with a lower tracking error, it's not 100% the case, but it will almost always mean that the breadth of your overall portfolio is bigger, so you will be invested in more stocks overall. Yes. Okay, so you're going to have a multi-manager portfolio. You know that you want them to be not too highly correlated. What else do you consider when you actually pick those managers? What we say is we say that you look for the Ps. Now, there's always a different number of Ps that people cite, but these are 5 that I think work very well. When you select your managers, you look at their philosophy, their process, their people, their portfolio, and their performance. Combine all 5, which is what we've been looking at today, and then, if you're confident that all 5 are ticks, you can be confident that the manager is a good pick. Right? It's no good having a good philosophy if you don't have a clear process. It's no good having a good philosophy and process if you don't trust the managers themselves. If you do trust the managers and they have a good philosophy and process, then it's important that the portfolio is a good addition to your own existing portfolio, particularly if you're multi-manager investing and want to diversify style exposures. And it's no good having all of those if performance is rubbish, because then you're just going to reduce your return overall. And with truly awful spelling, you could come up with a 6 that isn't a true P but is important, and that is fees. Right? Even if performance is great, if the fees are large enough that the manager walks away with all of that excess performance, your end investors aren't going to be better off. So to get an idea of how the industry views all of these different factors, these are outcomes from that paper I told you about where Jeff went and actually interviewed some of the managers at the top of the big super funds. What we have is, out of every 10 interviews, the number of people that said an item was important. So you can see that everyone cared about performance history, but no one just took past performance at face value. They analysed the performance to understand the source of the returns. And about half of them cared about a decent track record, but the other half didn't. Everybody cared about the people. Remember that quote, it's the people, the people, the people. You need to trust the fund managers and believe in their skill. Everyone cared about fund size, but few people had a view that few people thought that bigger or smaller was better. What people did is analyse the relationship between the strategy and the capacity of that strategy versus the funds under management. Right? You don't put your money in a small cap fund if there's a huge amount of assets under management and therefore there isn't enough capacity in a small cap strategy before price impact eats away the profits. People care about fees, but they didn't necessarily only go for low fees. They were happy to go for managers that charge high fees, provided they believed that their returns were good enough to more than offset those extra fees so that the end investor did walk away with alpha. It wasn't all taken by the manager. People cared about the way the business was run, and 80% of respondents cared about whether a particular fund was a complement to their overall portfolio, whether it was a good diversification, for example. So the type of things that we've been looking at through the course, these are top Australian superannuation funds, and the managers really care about this stuff. So the last thing I wanted to look at today is, all right, we've been assuming through a lot of this course that we're going to go a lot of this lecture that we're going to go active in our investments. It's not always the case that active is better. Yes, active can give you alpha, but only if the manager is skilled and only if the fees are not so high that that alpha is eaten away. So what we have here is the classic debate that's been going on for decades between people that believe you should be active and people that believe that you should be passive. So if you think about this as sort of a boxing match, we're going to start in the top left with the passive corner. The passive is going to be attacking the active, and the active is going to be defending why you should actually be active, not passive. Which actually tends to be the way it goes, because the people that believe in passive investing, the Bogles of this world, Bill Sharp, they're very, very firm in this belief. And so they write a lot of articles saying you should be passive, you should be passive, you should be passive. The first thing that always comes up for people that believe passive is better is the argument that active management is a zero-sum game. Remember, we said this in week 5. This is Bill Sharp's arithmetic of active management argument. If you take all of the investors that exist in the world, combined, we need to hold the market portfolio. If you remove the passive investors, because the passive investors hold the market portfolio, the active investors in combination too need to hold the market portfolio. Now, if all of the active investors combined hold the market, then by definition, combined, they can't beat the market because they hold the market, which means that for every active investor that gains, there's an active investor that has to be on the losing side of that trade, right? That's the argument. What the active managers most commonly tend to come back with is there's more than just active fund managers in the active subset of investors. Yes, there are active managers, but there's also anyone else that doesn't happen to be passive. There are liquidity traders, there are noise traders, there are mums and dads that get a kick out of buying stocks. There are 18-year-old kids that have inherited their first trading account on turning 18. There are a bunch of people that are trading because they want to, and not all of them are hired to be active managers, and not all of them are skilled. So it might be that for every active investor that wins, another active investor loses. But active fund managers argue that they are the ones on the winning side of the trade, exploiting the less informed or less skilled active investors. So then the passive investors say, all right, fine, let's say that you can produce a positive alpha. You also charge ridiculously high fees, right? So Ken French, that's Farmer French model, in his presidential address in 2008, he wrote a paper called The Cost of Active Investing. And what he showed is that the average investor in the US spends 67 basis points a year trying to beat the market. And if you assume, as French did, that that attempt was pointless because there is no overall alpha, then investors would immediately gain 67 basis points each year just by switching to a passive fund. What the active investors say is, listen, no one would be active if there weren't returns to be gained. Right? So, all right, we do charge high fees, but because we're still being active, we must at least benefit as much as we charge. There must be information inefficiencies, or why would we be in this profession? So that might mean that there's no alpha or zero alpha after fees, but there should at least be positive alpha before fees, and that shouldn't translate to a negative alpha overall. You don't need to know the deep details of any of these, but it is interesting to see. There's no right answer. The debate will not be solved anytime soon. Okay, so the passive people then say, well, that's a really good theoretical argument, but look at your track record. I mean, in the US, the average active fund underperforms their passive counterpart significantly after fees. And the active guys say, well, okay, first of all, what's true in the US doesn't need to be true anywhere else. So in Australia, small cap managers do really well in the active space. And on top of that, investors don't invest in the average manager. It's all about picking a manager that you believe is the right manager. So as long as you pick the skilled managers, it doesn't matter if the average active manager underperforms. The trouble with that is everyone thinks they've got a skilled manager and everyone can't all be right? So you've still got that average underperformance. The one concession that the passive investors give to the active investors is, look, we don't want you to disappear completely. Because the reason that we believe markets are efficient is that if there ever is a little bit of divergence away from true value, you guys will pick up on it and trade. But the fact is, the average manager doesn't outperform. There's a bunch of investors paying active managers to try to outperform, which they're not succeeding. Yes, that's creating an efficient market, but we don't need to pay the active managers anything and we're benefiting, right? So it's that free rider problem. Again, the active managers say, well, all right, sure, there are people out there paying money to active managers and they're not getting returns, but as long as you pick the right manager, not only are you aiding in market efficiency, but you are benefiting more than you spend. So the end investor is ending up with average alpha overall. With positive alpha overall. I don't think there's going to be a solution that comes anytime soon. I do think it depends on the market, and I also think it depends on the time. I think there are some environments where it makes sense to be active and others where you're better off being passive. That's just my view. Okay, so the last thing is you might not actually have a choice, and the one choice might not be the same for every investor. So this is a really nice framework that is very simple and easy to apply to help us make the decision of active or passive. You start with question 1 and work your way down, and if at any point the answer shoots you across, you go active instead of passive. If you stay always going down the left, you end up passive. So the first thing you say is, well, is there a passive option? If there's not a passive option, you can't go passive. You need to go active. Right? So if you want to invest in private equity as an asset class, there is no passive private equity index. You need to go active by the very nature of private equity. But if there is a passive option, you then ask yourself, is it suitable? So first of all, is the cap-weighted index, so the passive option, at odds with my objectives? Am I an ESG investor and the passive option has non-ESG stocks included? That would give me, it might be enough to just tell me to go active, or it might give me a preference for being active, at which point I'll weigh the benefits and costs, and providing the benefits are more than the cost and I can access it, I'll go active. Or if I say, no, there is a passive option that is consistent with my objectives, you then say, well, is that passive option efficiently constructed? Because if it's something like fixed income, then even if there is a good passive option in terms of your objectives, we know that fixed income indices, the passive indices, have a lot of problems. That might be enough to suggest that you go active, particularly if you can access it and the benefits outweigh the cost. But if there is an efficient passive option, you then say, well, do I expect active management will outperform? In which case I might still want to go active anyway. If you think that the investment environment is good for active managers, that might be enough to tell you to go active if the benefits outweigh the cost. But if you think, like in the US, that the average active manager doesn't outperform, you keep going down, and if you can, even though the average doesn't outperform, identify a skilled manager, then you can still go active. But if you can't identify a skilled manager, you stay passive. Okay, so it gives you a set of questions that will help you in making your choice. All right, thanks, guys.